Credit. It's everywhere. Credit cards, personal loans, home loans, interest-free loans, nothing to pay for 3 months offers. It's an everyday part of our lives. It's also an everyday part of business. Virtually every supplier, whether in the manufacturing or service sector, will offer their customers goods or services that they won't expect to be paid for up front. But there's a danger with credit. Some individuals get themselves into serious debt and can't pay their bills. Companies go into liquidation and don't pay their suppliers. And sometimes credit is extended to individuals and companies that are untrustworthy and who never intend to pay. So credit can be risky. So why offer it in the first place? Wouldn't it be better for everyone if we all insisted on cash up front?
Credit is a necessary part of doing business. What goes with that, of course, is that when you give credit, you need to make sure you test the credit worthiness of the people you give that credit to.
Credit is a great means to attract and retain new customers. It offers customers the ability to purchase now and pay later.
Companies offer credit to expand their possible market. If you only offered customers the possibility of dealing for cash, there'd be very few customers these days who'd be interested in dealing with you. They'd go to another supplier.
Minimising the risk of credit is about policies and procedures and ensuring that they are being followed.
Before we look at how companies handle credit, we first need to understand how they handle revenue, particularly the accounts receivable. The accounts receivable represents the recognised but uncollected revenue. In other words, the right to receive cash from a customer for goods and services that a company has provided. To illustrate this, let's say that company X has sold goods worth $1,000 to a customer on 30-day credit terms. In the accounts, we credit our sales service revenue with $1,000 in recognition of the sale. But the company hasn't received the cash, so we need to show that by debiting the accounts receivable by $1,000. Within a company's statement of financial performance, the transactions contained within the accounts receivable would be valued at the net realisable value. This is where the cost of credit is accounted for in the form of a provision for doubtful debts, basically an allowance for bills outstanding that the company thinks might not be paid. So there will always be some people who won't or can't pay. What can you do to keep the bad debts to a minimum? What should and shouldn't you do when assessing creditworthiness? Let's take a look at how two different companies in the telecommunications sector handle credit risk. The industry leader, Telstra, and our old favourite, the failed One.Tel.
When a customer is looking for a new service or to enter into a customer relationship with us, we will do some checks on their credit worthiness by doing, similar to a bank, a 100-point check. We will also see if they've been a customer before. There are still credit checking reference agencies that we also check to make sure that they haven't been put on a default list or something like that. So we do those sort of checks.
As we've seen, credit checks are an essential way of minimising the risk of credit. At Telstra, they'd obviously checked that you were who you claim to be. So how come Astro Boy, Homer Simpson, Fred Flintstone and Yogi Bear from Yellowstone all successfully opened accounts with One.Tel and, not surprisingly, ended up appearing on One.Tel's bad debt list?
As a new entrant to the market, they necessarily had to go for a different group to the mainstream players like Telstra and Optus, and so they tended to chase a younger demographic. So these were teenagers, people maybe who were out of work who wanted to get into mobile telephony, but they were basically people who the big phone companies steered away from because they worried about whether they'd pay their bills or not.
But why did this happen? Why was One.Tel accepting such low value and high risk customers? The initial reason is that the company was driven by the bonuses they were receiving from Optus for each customer they signed up. At that stage, it didn't particularly matter how much the customers spent on their services, as One.Tel was receiving $120 for each customer they connected to Optus's network. In this environment, volume of customers was the key, not quality. Even after the bonuses had been removed by Optus, One.Tel was still keen to demonstrate to investors that customer numbers were growing strongly. Other problems were adding to One.Tel's woes.
The billing system was designed for about 50 or 60,000 customers, but they were so successful in getting in new customers that by this stage, a couple of years down the track, they had about 750,000 customers. And on top of that, we had a new tax system with the GST adding new complexity. One.Tel had sprung into a whole lot of new areas which they weren't going to go into, like local telephony and long-distance telephony, and which meant that they had about 1,000 different pricing options, and the billing system just wasn't designed for that.
This combination of late billing, low value, high risk customers, unhappy good customers and tricked customers was turning into a lethal cocktail. Debts were building. So what did One.Tel do about it? To fully appreciate One.Tel's solution, we first need to take a look at how bad debts are normally handled within a company's accounts. There are two main ways that a company can address bad debts. The first way is the direct write-off method, where a company can constantly analyse each receivable and has sufficient information to make judgments. They can write off a debt as bad when they have direct evidence to suggest that the debt in question is unlikely to be repaid or is significantly impaired. This may happen if one of their customers notifies them that they've gone into liquidation. Within the company's accounts, the bad debt expense would be debited and the accounts receivable credited by the amount owed. In reality, this method is rarely used as there is no provisioning for bad debts. So unless the bad debts are immaterial, which is an unlikely scenario in the business world, an accounting standard is required that gives a more accurate picture by allowing for bad debts. This brings us to the second and more widely used way, which is to make a generalised estimate of the year's bad debt expenses. This is known as the provisioning method. It's a two-stage process. The first stage is to create a provision for bad debts. Although the company doesn't know exactly which debts will go bad, they create a provision, an allowance, for debts that they think are doubtful. The second stage is to then write them off. Part of this approach is to assess which debts might go bad by using the ageing method. With the ageing method, companies sort their receivables by days outstanding. Experience tells them that the longer they wait for payment, the higher the chances are that they won't recover the debt owed. Consequently, the longer a debt hasn't been paid, the higher a provision the company needs to allocate to that debt. The provisioning factors would usually be derived from the company's historical experience, although this may be altered to reflect economic circumstances.
The best way any company can keep their bad debts low is to make sure they get that upfront process right. While you've got that customer as part of your business, you just need to keep a watch on the age of your credit and make sure that you are always checking payment terms, that people are meeting payment terms, that as the debt ages that you follow them up.
So how did One.Tel handle their outstanding receivables? The standard way for companies to handle their debts is to recognise that the older the debt, the higher the chance that it won't be recovered. When they reach a certain age, they write them off as bad debts. In January 2001, more than half of One.Tel's receivables were over 90 days and a third over 330 days old.
They brought in someone from Telstra who worked on the rule that in terms of bad debtors, you would have 20% of bad debts to 80% of paying customers. He came to One.Tel and found they had 20% of good paying customers and 80% bad debtors. And they just simply weren't recognising these people in their books, that they were all customers, and the fact that they weren't paying didn't really matter to One.Tel.
According to one senior collections team manager at One.Tel, quote, "The bad debts were the ones that Jody Rich, the chief executive, accepted could not be collected. The real figure was always higher. We might tell him that 95% of a category was uncollectible, but he would say he wanted us to collect half of it, so only half was counted as bad." In this way, the bad debts that would normally have to be written off were reduced, and the impact of the bad debts on the bottom line was softened. Even with this manipulation, the 2000 accounts show that their provisioning for bad debt, the money they were publicly acknowledging that they were unlikely to recover, was $46.4 million, nearly 38% of their accounts receivable. One.Tel was beginning to pay heavily for neglecting their credit checks and not managing their accounts receivables properly. Staying on top of billing and bad debts is a vital part of keeping a business healthy. Cash flow is the lifeblood of a company, and good credit control and bad debt minimisation ensures that blood keeps flowing well. Sales may be soaring, but if the money isn't coming in and the debts are building, there will be trouble ahead. And in the same way that the medical profession uses monitoring equipment to gauge the health of a person, it's the accountants and their systems that assess the health of a company and check that the sales are turned into real revenues. As One.Tel discovered to their cost, these are processes that are worth getting right.